Ladies and gentlemen, pause for a moment and ask yourself this simple question. When the system needs a $34 billion emergency injection, is that a sign of strength or a confession of stress? Today, silver didn't just fall, it collapsed nearly 14%. And while headlines will rush to blame market volatility or profit-taking, the real story lives deeper, beneath the surface where liquidity, confidence, and power intersect. This is not just a price move, this is a message. And if you learn how to read it, it can change the way you see markets forever. When a financial system requires a $34 billion emergency liquidity injection, it is revealing far more than most headlines are willing to admit. Markets are built on confidence, and confidence is sustained by the belief that capital is available when needed. An emergency intervention of this magnitude signals that this belief was at risk of breaking. And institutions do not request or deploy such liquidity because conditions are normal. They do so because funding channels are tightening, counterparties are hesitating, and the smooth circulation of money, the lifeblood of modern finance, is under threat. This is the first and most important signal the sophisticated market participants watch, because liquidity stress always appears before broader market instability becomes visible. The real hook lies in understanding why liquidity suddenly becomes scarce. In highly leveraged systems, even a small disruption can cascade into a large problem. When asset values decline or volatility spikes, margin requirements increase and lenders grow cautious. Borrowers who were comfortably funded one day can find themselves scrambling for cash the next. A $34 billion injection suggests that private markets were no longer willing or able to absorb this pressure on their own. That moment, when intervention replaces market-driven funding, marks the transition from routine volatility to systemic concern. Another critical element is speed. Liquidity crises do not unfold slowly, they erupt. Funding markets can freeze within hours, and when that happens, decision makers act aggressively to prevent panic from spreading. The size of the injection reflects not just the scale of the immediate problem, but the urgency to restore confidence before fear becomes self-reinforcing. Once participants begin to doubt the availability of liquidity, they pull back simultaneously, creating a feedback loop that no individual institution can stop, and emergency support is designed to break that loop, even if only temporarily. What makes this moment especially telling is that liquidity injections are often framed as preventative measures. In reality, they are reactive. They respond to stress that is already materialized somewhere in the system. Often out of public view, this stress may stem from concentrated leverage, mismatched maturities, or exposures tied to volatile asset classes. The injection acts as a signal flare, illuminating the fact that risks were underestimated and that existing buffers proved insufficient under pressure. The deeper implication is that repeated reliance on emergency liquidity gradually reshapes market behavior. When participants expect intervention, risk-taking increases, leverage builds, and the system becomes more fragile over time. Each rescue stabilizes the present while quietly increasing future vulnerability. That is the paradox at the heart of modern financial markets. And it is why experienced investors treat emergency injections not as reassurance, but as warnings. The most powerful insight comes from recognizing that liquidity is not infinite. Even when authorities appear willing to provide it, every intervention carries costs, distorts pricing, and alters incentives. A $34 billion emergency move is not a sign that control has been regained. It is evidence that control was momentarily lost. Those who understand this do not react emotionally to market swings. They read liquidity signals as early indicators of deeper structural stress, positioning themselves with clarity, while others remain focused on surface-level explanations. When silver fell nearly 14% in a single session, the instinctive reaction was to assume something had gone wrong with silver itself. That assumption is the trap. In moments of financial stress, markets do not sell what is weak, they sell what is liquid. Silver sits at the intersection of deep market access, constant pricing, and immediate convertibility into cash. That makes it not a liability in a crisis, but a tool when balance sheets come under pressure. Assets that can be sold quickly without completely collapsing the market become the first line of defense, and silver fits that role perfectly. The real hook lies in understanding forced behavior. Institutions do not always sell because they want to, they sell because they must. Margin calls do not negotiate, And funding desks do not wait for better prices. When leverage is involved, falling prices trigger automatic requirements for additional collateral. If that collateral is not available, positions are liquidated regardless of long-term conviction. Silver's sharp decline reflects this mechanical process, not a sudden reassessment of its monetary or industrial value. This dynamic explains why silver often falls alongside risk assets during liquidity events. Even though it is widely viewed as a hedge, in theory, silver protects against systemic instability. In practice, during the initial phase of stress, it becomes a source of cash. The irony is that the very qualities that make silver valuable over the long term, liquidity, transparency, and global demand, are the same qualities that expose it to aggressive selling when cash becomes scarce. That contradiction is where many investors lose clarity. Another critical element is market structure. A significant portion of silver trading occurs through futures and derivatives, where leverage is embedded by design. When volatility spikes, these markets react instantly. Stop-loss orders are triggered, algorithms amplify momentum, and price moves extend far beyond what fundamentals alone would justify. What appears as panic is often a chain reaction driven by rules, models, and risk limits rather than emotion. Understanding this removes fear from the equation and replaces it with perspective. There is also a psychological hook at play. Sharp declines shake confidence and create the illusion that an asset has permanently lost its relevance. Yet history repeatedly shows that assets sold for liquidity reasons often recover once forced selling exhausts itself. The market does not announce when this process is complete. It simply moves on. So those who misinterpret liquidity-driven sell-offs as fundamental failures often exit at precisely the wrong moment. The key insight is that silver's role during crises is misunderstood. It is not immune to stress. It is central to it. Silver is part of financial plumbing, and when the system tightens, the plumbing gets drained first. Recognizing this distinction allows market participants to separate short-term price violence from long-term value, and to read sharp declines not as verdicts on silver, but as reflections of stress occurring elsewhere. In the financial system, the most violent market moves rarely begin with panic. They begin with leverage. Leverage is attractive in calm conditions because it magnifies returns, lowers perceived risk, and creates the illusion of control. But leverage is also unforgiving. When prices move against leveraged positions, the adjustment is not gradual, it is immediate, mechanical, and relentless. This is why periods of stress transform ordinary market corrections into sudden collapses. The unwinding process does not wait for analysis or sentiment to improve. The psychological hook emerges when investors mistake this process for collective fear or irrational behavior. In truth, much of the selling is pre-programmed. Risk systems are designed to protect institutions from catastrophic loss. Even if that protection amplifies short-term volatility, the market appears emotional, but the drivers are mathematical. Recognizing this distinction allows sophisticated participants to remain analytical while others react emotionally to headlines and price action. The deeper implication is that leverage transforms time. It compresses months of price discovery into days or even hours. Moves that might have unfolded gradually in a less leveraged system now occur in bursts, leaving little opportunity for adjustment. This is why leverage unwinds are remembered as crashes rather than corrections. They are not reflections of sudden economic collapse, but of a system adjusting rapidly to constraints it can no longer ignore. Liquidity injections are often presented as decisive solutions, but in reality they function more like temporary pressure valves. They release immediate stress while leaving the underlying structure largely unchanged. When authorities step in with emergency support, the objective is not to fix the system, but to prevent it from seizing up in the moment. This distinction matters because markets frequently mistake short-term stabilization for long-term health. The real hook is recognizing that relief and resolution are not the same thing. At the core of this issue lies structural imbalance, excessive debt, maturity mismatches, and dependence on continuous refinancing cannot be cured by liquidity alone. An injection provides cash, but it does not reduce leverage, eliminate bad assets, or restore sustainable cash flows. It simply buys time. During that time, confidence may return temporarily, spreads may narrow, and volatility may ease. but the conditions that cause the stress remain embedded in the system. When that time runs out, pressure resurfaces, often in a different form. Another critical dimension is incentive distortion. When markets come to expect intervention, behavior changes. Risk-taking increases because downside consequences appear manageable. Institutions stretch balance sheets further, funding long-term exposures with short-term money, confident that support will arrive if conditions deteriorate. Each successful intervention reinforces this belief, making the system more fragile with every cycle. The irony is that measures designed to enhance stability can gradually erode it. The hook deepens when you consider how liquidity affects price signals. Market prices are supposed to reflect risk, scarcity, and demand. Large-scale injections interfere with this process by suppressing volatility and compressing risk premiums. Assets that should reprice lower remain elevated. While inefficient structures persist longer than they otherwise would, this delay does not eliminate adjustment. It postpones it. When adjustment finally occurs, it tends to be sharper and more disruptive. There is also a temporal illusion at play. Liquidity creates the appearance of progress because conditions improve quickly after intervention. Markets rally, sentiment shifts, and narratives change. Yet beneath the surface, dependence on ongoing support increases. The system becomes conditioned to operate only under assisted conditions, making future stress episodes more severe. Each round of support raises the threshold for what qualifies as normal, narrowing the margin for error. The most revealing insight is that liquidity injections shift problems forward in time rather than resolving them. They transform immediate crises into medium-term vulnerabilities. For those who understand this, interventions are not comfort signals but warning signs. They indicate that organic market mechanisms failed to absorb shock, and that future stability now relies more heavily on continued support. Reading these signals accurately allows participants to prepare for volatility rather than being surprised by it when temporary relief fades. But when stress emerges in one corner of the financial system, it rarely stays contained. Modern markets are deeply interconnected, not just through sentiment, but through balance sheets, funding channels, and shared sources of leverage. Losses in a single sector force institutions to reassess risk across their entire portfolios. This is how pressure migrates. What begins as a localized problem quickly evolves into a broader repricing of assets. Even those with no direct fundamental connection to the original source of stress. The hook is understanding that contagion is not driven by fear alone, but by necessity. The mechanics of this process are rooted in capital preservation. When an institution absorbs losses, its capacity to take risk shrinks, risk limits tighten, credit availability contracts, and internal models demand a reduction in exposure. This reduction is not selective in the way retail investors might expect. Assets are not sold because they are related to the problem, but because they are available, liquid, and effective at restoring balance sheet stability. As a result, unrelated markets begin to move in the same direction, creating the illusion of a single narrative driving everything at once. Another powerful accelerant of contagion is shared leverage. Many institutions rely on similar funding sources and employ comparable strategies. When conditions deteriorate, these similarities become points of vulnerability. A shock in one market raises funding costs or collateral requirements across the board. Institutions respond by cutting exposure wherever they can, transmitting stress from one asset class to another. This synchronized response amplifies price moves and compresses timelines, making adjustments feel sudden and disorderly. There is also a behavioral hook that magnifies contagion. Once volatility rises, uncertainty spreads faster than information. Market participants begin to price not only known risks, but unknown ones. This leads to a broad repricing of risk premiums. Assets that were previously considered insulated are suddenly evaluated. Through a different lens, the market's question shifts from "what is this asset worth?" to "how exposed could this asset be if conditions worsen?" That shift alone is enough to drive coordinated selling. The deeper insight lies in recognizing that contagion reveals the true structure of the financial system. It exposes where leverage is concentrated, where liquidity is thin, and where assumptions of independence break down. These episodes act like stress tests conducted in real time. Prices move not because fundamentals have simultaneously deteriorated everywhere, but because capital is being reallocated defensively under constraint. Those who misread contagion as irrational panic often exit markets at the point of maximum pressure. Those who understand it as a balance sheet-driven process gain clarity. They recognize that cross-market declines are signals of systemic tension, not universal failure. This understanding does not eliminate risk, but it replaces confusion with context, allowing decisions to be guided by structure rather than emotion. The violent price swings often feel chaotic, but volatility is not randomness. It is communication. Markets use volatility to transmit information when existing prices no longer reflect reality. During periods of stability, imbalances can build quietly as risk is underpriced and leverage accumulates. When conditions shift, volatility becomes the mechanism through which these hidden tensions are revealed. The hook is understanding that sharp moves are not market failures, but recalibration processes that unfold rapidly once constraints are breached. The most valuable insight is that volatility often precedes structural change. It appears before new trends are fully recognized and before stability is reestablished. Those who interpret volatility as noise miss its informational value. Those who understand it as a transitional signal gain an advantage. They focus less on predicting precise price levels and more on identifying shifts in regime, liquidity, and behavior. In this sense, volatility is not the enemy of clarity. It is the path to it, guiding informed participants through periods of uncertainty with evidence rather than illusion. As I bring this message to a close, I want you to carry one powerful idea forward. Don't confuse volatility with failure. Don't confuse emergency action with stability. And don't confuse short-term crashes with long-term truth. The $34 billion injection and the 14% silver crash are not random events. They are signals that the game is changing. And only those who think clearly under pressure will stay ahead. Stay calm, stay curious, stay disciplined, because in a world addicted to emergency injections, clarity is your greatest asset and understanding is your real silver. But